Hi there, welcome to Kneppy Invest. I hope you love Seas of Red because the ASX today was just an absolute bloodbath. Sea of Red, companies who released their financial reports on February the 27th, more than likely released a bad one. Not all the companies that did release a report today released a bad one. There were a few good reports led by Reese, up about 20%. But it seems like the majority of companies who release their reports today released bad ones or ones that the market didn't like, led by DGL Group. Share price down 42 cents or 41%. So I'm going to have a quick look at this company's half year results just to see if there's anything interesting in them, just to see if I'm willing, and I'm just saying this for or as a possibility willing to take a bet that the market has overreacted because sometimes when the company's share price drops 41%, it could be that the market is overreacting. Is this the case for DGL Group? So let's start on a positive note and look at the best performing companies today because even though it was a sea of red, it was a bloodbath, there were some good results from companies. Now, this is the top gainers from Market Index. The time now is 3:32 p.m. So this should be updated because it is 20-minute delayed. And the closing auction finishes just around about 3:10 Brisbane time, 4:10 Australian Eastern Daylight Saving Time. And the best performing company on the ASX, I'll just zoom in a little bit here. Best performing company on the ASX is a company called Audira, AUA. I did have a look at this company's announcement and it did intrigue me. So it's no surprise share price is up almost 100%. The market cap of that company is only 9.4 million. So more of a story stock. The best performing company who did release their results today was Reese Limited, REH, share price up 18.3%. Other companies that released good results today, well, that's about it. Quantum Intellectual Property, a company I am trading right now, up 17% on the back of some takeover rumors. I usually take profits when there are takeover rumors, but these rumors are fairly wishy-washy right now. So I'd like a little bit more clarity on these takeover rumors. So what I'm going to do now is list these by market cap because we might get a better indication of some other companies that release good half-year full results. Coles Group, up 5.8%. That's a pretty good movement for that type of company. Helia Group, up 8.1%. G8 Education, 11.6%. I had a quick look at that result. A company I would never, ever buy, but 11.6% because the results on the surface did look pretty good. Main Pharma, I'm pretty sure, released their results yesterday, and I'm pretty sure the share price rallied pretty good. So looks like the market really likes their results because 2 days of rally. I think the same with Adairs, up 6.2%. Oh, I'm so glad I did not sell out of step one, up 13.6%. And there we have Quantum Intellectual Property. So some companies did do well today. But when you compare it to the companies that did really bad today, it's no comparison. So let's have a look at the top losers today in terms of percentage change. And the worst performing company on the ASX was DGL Group, down at 41.3%. So I'll have a look at their financial results in a second. BrainChip, down at 33.7%. In fact, I might update this to take into account the closing auction, but BrainChip down 33.7%. So maybe it seems like the short-term hype in that company has come to an end. Company released their results, and no shock, the results weren't good. I'm not sure what the market was hoping for. AccuSensus, this was really interesting. They did not release their results, but they were not successful in a tender. I am a little bit surprised the share price decreased 33.33%, or a third, on the back of a company not being successful in a tender. So it seems like the market expected this company to win every single tender they were going for in the world. I think it was in Western Europe or somewhere like that. So a possible sneaky buy there because I was looking at a trade there, but I think maybe a 33% decrease in share price is a little bit too much. Articore, I'm pretty sure this used to be Redbubble, down 31.3%. Did not have a look at their results, but the market hated it Pro Packaging, not sure if they released the results. Ashley Services did, down 27.5%. Trajan Group, they released their results, down almost 19%. Had a quick look at that company, and I can understand why the share price fell a fair bit. Silk Logistics down 16.2%. So that's in terms of percentage changes. Now let's have a look at markups to see if there's any other company. And there is. Johns Lyng Group, 13.1%. A company I do own in my quality portfolio. I can say right now, that company's results surprised me in terms of revenue going backwards. And maybe I shouldn't be surprised, and profit going backwards. Seems like the market might have been a little bit surprised. But they also announced a profit upgrade. So it seems like the market was confused. Maybe not confused, but the market saw a profit upgrade, but then they saw the results and went, what do I really focus on here? The results were negative, yet profit upgrade. What am I going to do? Helios down 7.9%. Share price of that company will define downtrend. Zipco, really interesting trading. Share price opened about $1 and then selling started. Share price down 13.9%. We also saw that with Tyro Payments. In fact, Tyro Payments share price at one point in the day, in first like 1 or 2 minutes, opened up about or rose to about $1.30. And then the share price finished about $1 or just above $1. Other companies, there we have Tyro Payments, closed at $1.09. Australian Clinical Labs, I don't remember that company releasing results. Maybe I'm mistaken. ReadyTech did, down 7.8%. Any other companies here? Shitty Chic. I'm pretty sure they released their results yesterday. I could be mistaken. And those results were pretty bad. And that's about it for now. National Tire and Wheel released their results, down 7.8%. And TPC Consolidated released their results after trading finished yesterday. Share price down 11.2%. And the Nextad released their results yesterday. Share price plunged and down a further 12.9%. So bad news for shareholders of that particular company. So let's have a look at DGL Group. Down 42 cents or 41%. Now, funnily enough, when we look at the chart for this company, you'll notice that actually, before we have a look at share price of this company, let's have a look at Zip, because the trading of Zip and Tyro Payments was really interesting. So initially, the market liked it. And when I say initially, I'm talking about the first minute of the trading. So let's have a look at the 1 minute trading for Zip, and we'll also have a look at Tyro Payments. So you can see where trading started today. In fact, Zip's share price opened up about 5.4%. So initially the market liked the announcement, and then the selling started almost immediately within the first few minutes, and the share price went from almost $1 all the way down to about 84 cents in about 20 minutes. In fact, 24 minutes. And then the share price kept on decreasing fairly slowly, but that's all it took. 24 minutes for the sentiment in this company to change from positive, wow, it's up 5%, to down about 10%. And the other one was Tyro Payments. So this company share price opened up pretty high. So share price opened up about $1 and what was it, 30 cents or something? Yeah, $1.30. And you can see this is 1 minute charts. So then in the first minute, we started to see the selling, and the selling was relentless in the first 10 minutes. That selling drove the share price down from $1.30 all the way down to $1.05. And it only took 23 minutes, just like Zip. A nice little rally in the last 2 hours of trading. Share price went from $1.01 up to $1.08. So maybe the selling has stopped for Tyro Payments. Had a quick look at their results, and I could have seen a scenario where the share price rose or fell. So I actually am not surprised that there was a little bit of confusion in the market around this company results. And that's all she wrote. Was there any other company? Yeah, it looks like City Chic did release their results today, because I have them listed by the time they did release their results. But any other companies here that I did not talk about? Helios. And then some companies' share price did not move at all, like Digger Data. It was flat, almost flat, maybe a slight rise. A few other companies rose a fair bit. HePad Education, I don't know anything about this company, up 10.6%. Appen, up 15.5% on the release of their results. Wow, the market liked it. And Prosper, I think there was a proposed takeover of Prosper, up 13.3%. So let's have a look at DGL Group to maybe not get an understanding of why these companies. Let's have a look at the results, the media release, and then I'll have a look at the Appendix 4D to see and probably try to understand why I sort of can see why the share price just stayed at 60 cents all day. I think you might be seeing some value investors right now having a look at their financial results, having a look at the financial numbers and going, wait, this company is now trading below net tangible assets. And that's pretty important. So this company, well, technically, this company could sell all their uh, tangible assets, and you could sell them at a greater price than 61 cents per share. You could sell them at, I think it was 71 cents per share. Technically, doesn't mean they would do that. Doesn't mean they could do that, particularly because they have a lot of property, plant, and equipment. So that's one of the reasons why I think there could be some value, and one of the reasons why I actually added to my trading position in this company. So you might say, well, share price dropped 40%. I probably should sell because negative results, but I wouldn't be surprised to see the share price bounce towards 70 cents. Now, on the surface, results, initially the results might not look that bad when you look at underlying EBITDA. Underlying EBITDA, 30.4 million, up 3%. Revenue, steady, flat, 217 million. Underlying EBIT down 14%. Statutory profit or NPAT down 43%. A strong underlying operating cash flow conversion, 93%. Don't care about that. Resilient balance sheet with net assets of 339.4 million, net debt of 117.2 million. That is a little bit of concern, but they do have a fair bit of assets. And do they mention anything in here? So they go through the segment performance. They have a couple of segments. Now, this company is really acquisitive, and that is a little bit of a red flag for me. In fact, they mentioned they acquired something like 4 businesses in the past financial year, somewhere here. Since June 2023, DGL has acquired the business and assets of QBlend and Ornex New Zealand Construction Products Division in the chemical manufacturing segment, and in one of the other divisions, logistics, they acquired the business assets and property of Kneppy Transport, and they might have acquired some other assets or other companies, environmental services, or maybe not. Okay, so 3 divisions. Now, my biggest concern in regards to DGL Group is just the lack of margins, really low margins. And when a company like DGL Group, who does exist on really low margins, have some little issues, you will see these sort of financial performance where the profit can plunge in 1 year, even though the revenue doesn't do anything, because of margin pressure. So this company has experienced margin pressure in this half year, and that's why profit has dropped significantly, but revenue is flat. Okay, now on to the financial statements. So usually with the financial statements, you get this first sort of a highlight, if you call it that, a highlight section. But in the highlight section, we have the net tangible asset backing per share, the net asset backing per share. I tend to focus on net tangible asset because this company does have intangibles, which is sort of like goodwill, because they are acquisitive and they buy companies probably more than they probably should, or what the company's worth, and they put that amount of which they bought the company at a greater amount than what it's worth into goodwill, intangible assets. So net asset backing per share is $1.19. So if you want to include intangibles, this company is worth $1.19 just based off the net assets. But if you take away their intangibles, this company has a net tangible asset backing per share of 71 cents. And that's why I think there is potential that we could see the bottom in this company's share price, just because of this one little thing. It's a little thing, but it is a thing, that the company is trading below net tangible asset. Doesn't mean the company is good value. Doesn't mean the company is quality. Doesn't mean you should rush out and buy shares in this company, because this was a bad result. And we know it's a bad result just by how the market reacted. But again, the market might have overreacted. And that's the big question. Has the market really overreacted, and will there be a bounce moving forward? Now, I probably could show you their results, but we don't see anything significant here. But this is the profit and loss statement. And I actually did have a look at this. And revenue was down slightly. So we'll say flat, but it was down slightly. But this is what really not piqued my interest, but this is what really I really noticed this. So revenue's flat, but employee benefits expense up about $13 million. I think the majority of this increase in employment benefits expense is because of acquisitions. So this is a big concern that they're spending $50 million on employees in one half. They have to keep that under control. And you'll think if they are acquiring other businesses, there should be some synergies, and some of those synergies would be less staff needed to run these companies. But it seems like they really ramped up the staffing levels by these acquisitions, yet revenue did not increase. So there's a little bit of concern. And there has been slight increases in other expenses, depreciation and amortization up to 14 million, net finance costs 5.1 million. So this company does have debt, and I'd love to see this company have no debt. And I am attracted to companies that have very little debt, if not net cash. That's not true for this company. And you can see one of the effects in a high interest rate environment, companies' net finance costs or financing costs are much higher, increasing from 2.8 million to 5.1 million. Okay, so a few red flags, I suppose you could say, for DGL Group just in their profit and loss statement. Now let's have a look at the balance sheet. So the big number here is total equity down the bottom. This company has total equity of 339 million, which means what I look for is return on equity. One of the things I do look for in terms of quality company is a return on equity above 10%, which means this company on a total equity of 339 million should be producing about $34 million of profit each year, not in half year, each year. This company is well short of that. So the return on equity of this company is really bad. And that's even though this company has a fair bit of borrowing. So $134 million of borrowings in non-current liabilities, only $4.5 million in current liabilities. And I'm pretty sure one of the reasons why the loans of this company have increased is because of acquisitions. This company is acquisitive, highly acquisitive. $21 million of cash, $55.4 million of trade and other receivables, $43.8 million of inventories. So that's something that they could sell. And property, plant, and equipment, $269 million just in property, plant, and equipment. Already talked about intangible assets, $145.3 million in intangible assets. Now, this is what might happen moving forward for this company, particularly if they don't perform financially in the next few years. What this company is going to do is write-downs, one-off write-downs of intangible assets. So maybe in financial year 2024, in the second half, the accountants will come to management and say, we have to write our intangible assets down. You have made some acquisitions and you completely overpaid for these acquisitions. And because of that, we have to write down intangible assets. And that's how this company could be a loss-making company by $100 million in 1 year to write down intangible assets from 145.3 million to 45.3 million. And then the next year, they have to write down those. Well, they don't have to, but you might see the company write down those intangible assets again. I've seen a few companies do this over time where they just write down intangible assets year after year. So don't be surprised if that happens with this company, particularly if they don't perform financially over the next few years. So a few red flags here, particularly the borrowings, but the very fact that if you take the total equity, subtract the intangible assets, this company is right now trading below net tangible asset. And that is attractive for me just because there is a possible value play right there. Now let's have a look at the cash flow statement. Anything exciting in the cash flow statement? So the first thing I look for is cash flow from operating activities. Now, this does not include changes in working capital. Now, to see the changes in working capital, particularly if you're looking at a full year results, they actually will have a note, reconciliation of profit to operating cash flow, but they don't have that in the half year. But you can easily calculate just by looking at the balance sheet and looking at changes in inventory, changes in trade and other receivables, and changes in trade and other payables. That is changes in working capital. So any big increase or decrease in those three. There was an increase in inventories, which will be negative to cash flow from operations. A slight increase in trade and other payables, and trade and other receivables, a slight increase there. So there might be a slight negative impact on operating cash flow just because of that increase in inventories. So sometimes you will have to take that into account. So let's go back to the cash flow statement. Now, the company did generate $19.3 million in operating cash flow, but this company is capital intensive. What I mean by that is they do spend a lot of money on capital expenditure, property, plant, and equipment. We already know that because this company has a lot of property, plant, and equipment on their balance sheet. And in this 1.5 year, they spent $21.2 million on property, plant, and equipment, which means this company was free cash flow negative in this half year. Now, last year, they're actually free cash flow positive by about $9 million. Now they're free cash flow negative by $2 million. That's another red flag. Purchase of business and assets, $13.9 million. I think they should just stop purchasing other companies. Try for some organic growth. So net cash used in investing activities, negative $36.4 million. So they're burning through about $17 million of cash in this half year, just in those two sections, investing activities and operating activities. So no surprise that the company's loans increased in this half year by $10.5 million. So we're not even talking about repayment of lease liabilities. This company has a little bit of lease liabilities, $8.6 million. You have to take all that into account. So a few red flags when it comes to DGL Group in this particular half year. Now, more importantly, well, just as important as all this financial statement and this number looking is any sort of guidance the company has given. Actually, in fact, I have no idea if the company gave any guidance or updated guidance. So let's have a look at the outlook. This could also explain why the share price decreased a lot if they did do some sort of profit downgrade. Now, they do expect the second half to be stronger than the first half. Well, they want it to be because it did look pretty negative, overall negative, I would say. Some significant red flags there. Similar to prior years. So they're saying in prior years, the second half is better than the first half, and that's probably fair enough. Although labour markets are expected to remain tight. And I will say labour market is going to remain tight for the foreseeable future because people are just not having babies anymore. Company has intensified focus on cost management and maximising efficiencies through tight integration of acquisitions. Interesting they said that because I'd like to see some synergies there. I'd like to see decrease in employee benefits, that sort of thing. While 4-year revenue and underlying EBITDA should be broadly in line with financial year 23, we expect net profit to be lower due to higher finance and depreciation costs as we invest in growing our network and asset base. So maybe this was a little bit of a downgrade, that they now expect net profit to be lower than financial year 23. We expect to see the benefits from these investments in coming periods. That remains to be seen. They have to be positive. We have to be negative as investors. I like to see that is my mindset. We are seeing increased demand for crop protection and pest control products and services. This will be in their chemical division, and stabilized commodity prices flowing through to raw materials in the second half of financial year 24. So that does seem to be a little bit positive. The company is positive about the outlook for the current half and beyond. Of course, they have to be positive. It would be pretty bad if they said the company remain or is negative about the outlook for the current half and beyond. In fact, if they actually did say that, I could understand why the share price plunged 40% or so. So again, I actually am trading this. This was a mistake I made by actually taking a trade position before the release of these results. Learning a lesson. It's good to make mistakes, and this was a really good learning experience for me, having a trading position in this company before they release the results. I'll talk about that more in another standalone video on this company, but just based off the 40% decrease in share price, not based off the financial statements, but just based off the net tangible asset per share, and the very fact that the company's share price is now trading below that, I think possibly the company has seen or will see some support at current share prices. So I bought some shares at 60 cents, and hopefully over the next few days, the share price bounces. If it doesn't, I'll take a loss and learn another lesson. So that's all I got for this video on DGL, down 40%. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can meet your demands, meet your needs, that sort of thing. Anyway, have a good day. Bye.